David Hunt, President and CEO of PGIM. Welcome.
Well, thank you for having me. It's great to be here.
Well, fantastic. Now, you join us on during Citywire's 25th year. So I wanted to start this conversation by asking you for some reflections. Now, I know you've not been at PGIM quite that long, but looking back at your period at the organisation and beyond, and in that quarter of a century, what are your reflections on how financial services and asset management have changed?
Yeah, well, first of all, congratulations to you and your colleagues on 25 years. I think that's a really an impressive milestone. And you have been covering the industry during some time of, I think, really rapid change. I've been in my role for 12 years, but I've been in the industry for over 30. And, during that time, it really has gone from what I would almost call a craft industry, which was, mostly relatively small firms that were highly specialized in particular asset classes, to a world now which looks fundamentally different. We have, for the most part, a widening gap between the firms that are doing well and the ones that are struggling. And the ones that are doing well tend to be large, global, and generally fairly diversified. And I would say that they're kind of three different types of firms that are doing well. One has been some of the big passive firms, where they have really driven a lot of assets into indexing and into passive ETFs. Another group has been the private alternatives, who many of them started in private equity, but they've moved into real estate and private credit. They've also grown really rapidly and become real global players in their own right. And then you have players like PGIM, who are, large, global, but we actually do both private and public asset classes. We're active managers. We live and die on our investment performance, but we're able to fully kind of cover the needs of most institutional clients. And that's been particularly important as we move more towards solutions. But what those three groups of players have done, as they have been winning, is that if you were just in one asset class, or you're just operating in one country, or you're just a long-only player, you're actually struggling. Now, it isn't actually consolidating in that we probably have more asset managers than we've had before, but the disparity between profitability and fundraising and flows between the three groups that I mentioned and everybody else is growing and growing. And I think that's going to continue.
That's really interesting. If you're a mid-sized asset manager, your advice would be grow quick, broaden your waterfront right now?
You really need to, because the public and the private markets are coming together. I mean, it used to be that, if we go back in history, that the private markets, they had their own media coverage, they had their own analyst coverage. It was almost like a separate world. And now what we see is that these worlds are coming together, and clients are saying, we want you to choose the relative value between public and private. And we want you to combine a private credit with public, or we want infrastructure and we want that to be partly debt, partly equity. Some of it'll be public, some of it'll be private. And so this idea that you kind of have a separation between the old long only and private doesn't work anymore. And therefore, I think the winning model is going to have both.
What is driving this trend? Spoke to people this week about selling alts to the wealth market. What's driving this appetite? You're talking about clients who are looking to an asset manager like yourself and saying you choose. But why is that question occurring in a way that it didn't so much before?
So really, large, sophisticated institutional investors are allocating more and more to privates. And in the early days, that largely meant private equity. And effectively, they decided that private equity was better on a risk-adjusted basis than public equities, and they moved money into that. Real estate has always been a big holding, and that's grown as well. But the big change, I would say, has been private credit, which over the last decade, it's been our fastest growing business. We're a very large private credit player, but it has been for others as well. And part of the reason for that is that after the GFC, banks really pulled back from lending. They stopped lending the way they did into the middle market. They've stopped being as active in asset-based finance. They've stopped being as active in project finance and infrastructure. And so LPs and GPs and asset managers such as ourselves have really stepped in to provide the funding for that. And that's a huge change in actually how the economy is funded. And it's meant there's a huge opportunity for asset owners to be funding that part from private portfolios. So this is a trend I think that will continue, and we will have a higher allocation in 5 years, I would say, than we do now to private alternatives.
Yeah, so, Citywire, certainly here in the UK and also globally, so much of what we do is to write for the wealth market. The big questions are about the suitability of some of these private markets investments. I know they come in different flavors for that segment. Mm-hmm, mm-hmm. And along with that, a segment that may want this stuff, but is also asking for things like liquidity, that wasn't sort of traditionally demanded in that way. Mm-hmm. So it'd be great to hear what your take on that is, because from our point of view, there is such a push for this market to embrace alts investments.
Yes, I mean, in a strange way, if you look at the returns that have been available to the institutional market, I think both high net worth, but even more broadly retail, would like to have access to some of that alpha. Now, as you point out, part of that alpha is being generated as a liquidity premium, because there's no question that part of what you're being paid for is the fact that these aren't as liquid. So our challenge as an asset manager is, how do we find the right vehicles and packages that will provide enough liquidity to a high net worth individual, but still retain the alpha generation quality to that. And I think we've made good progress over the last couple of years as an industry. More needs to be done if we're truly going to democratize this. But you will see, I think, a greater share of high net worth dollars going in to private alternatives over the next couple of years as we get more and more familiar with some of these drawdown vehicles.
Mm. Now, you talked about winners and losers in asset management writ large. In the private market sphere, you're hoping to be a winner. You are a winner. But what will be the defining characteristics of people who do win in this market, considering there are players who are trying to build up their capability there?
So you remember in my groups of winners, one of them was private alternatives, who were really only in private alternatives. They started in private equity, but they've moved into others. They have also been pushing into high net worth for sure, and I think done a nice job of it. The group that PGIM is in, and I think what we're winners, is that we do private. So we have over $300 billion in private alternatives. We're one of the largest in the world. But we also do long only. So what we can do is we can take public and private together and create solutions that use relative value trading across that, which for many pension funds, sovereign wealth funds, endowments and foundations, they want to be able to invest across that. And the private alternatives people who only do that don't have that ability, or at least not yet.